addition or disallowance, and based on that, the penalty was calculated and levied. Now, under this new regime, there are different categories of income being treated. Like there are underreporting of income, that is what we are discussing now under section 270A. There is also undisclosed income in consequence of a search, which is being captured in 271AAB. And there are deemed income, invoking the deeming provisions of the Act, like 69, 68, 69A, and other provisions, which attracts a higher rate of taxation, 115 BBE, for which a different penalty is being levied under 271 AAC. So, based on the nature of income of the addition being made, the penalty or the section in which the penalty is being levied are also being changed now. So, the rate changes, the procedure changes, the section changes. So, there's a huge departure from 271(1)(c), the earlier regime, and the new regime. And another interesting aspect to be seen here is 148 returns being filed in the case of a non-filer at that original stage, or shall be ignored for the purpose of this penalty. Throughout this penalty 270A, I'll take everyone through this presentation. We'll notice that the return of income filed under section 148 is being ignored while computing or for quantifying this penalty. Now, just an overview of the penalties being levied. The subsections covered in 270 capital A. There are basically 12 subsections of 270 capital A. And subsection, I just given an aerial view just for, I'll just take everyone through this and then go to each of the subsections. First is the scope of penalty being levied under section 270A. Subsection 2 talks about the scenarios constituting the underreporting of income. Once the scenarios is getting attracted, then comes the computation and levy of penalty. Subsection 3 talks about a computation of underreporting income, how the underreporting of income is being quantified. Subsection 4 and 5 deals with deemed underreporting in the context of intangible additions. That is similar to what was there in 271(1)(c), explanation 2 to 271(1)(c). Next is subsection 6, wherein exceptions are being carved out. There are basically 5 exceptions carved out. I'll discuss in detail. And subsection 7 talks about the rate or the quantum of penalty for underreporting. Subsection 8 is for misreporting, rate and quantum for misreporting. Subsection 9 deals about the instances of the misreporting, the bigger wrongdoing. And subsection 10 talks about the tax payable on such underreporting income. Subsection 11 has a specific subsection to avoid any double penalty being levied on the same addition. Subsection 12 basically talks about the order to be passed in writing by the specific officers. Now, getting into the subsection 1, the wordings used in 270A, subsection 1, are almost similar to 271(1)(c). Here also, the assessing officer, CIT or PCIT may direct during the course of any proceedings under this Act and direct any person who has underreported his income shall be liable to pay a penalty. So, first there is a discretion given in the form of may. Once the assessing officer directs, then comes the levy of penalty and the assessee shall pay. But one departure in this context from 271(1)(c) is that there in 271(1)(c) there was a precondition of satisfaction on the part of the AO or the CIT appeals initiating penalty. If he is satisfied that it is a fit case for penalty, he can initiate. Now, the recording of satisfaction or satisfaction on his part is being removed consciously from this subsection. So, it is only the word may which will be under scrutiny to decide whether there is a discretion or not. There need not be any satisfaction on the part of the AO, but again the word may, how it has to be interpreted, will decide whether the provisions of 270A is discretionary or mandatory. Now, coming to subsection 2, it talks about scenarios where the person shall be considered to have underreported his income. So, the wordings again used here is shall be considered to have been underreported. So, these are the scenarios which are deemed to be underreporting of income. Once this scenario gets attracted, automatically there is an underreporting of income by an assessee. Basically, there are 7 clauses being mentioned here, where most of the clauses, how it operates is, in the event of any variation in the assessed income being a higher amount than what was returned or processed under section 143(1), then automatically there is an underreporting of income. I'll just take you through the different clauses. The first is income being assessed first time. That is, income assessed is greater than the income processed under section 143(1). Next is, in the event of not filing any return of income or return filed under 148, it will be the income assessed is greater than basic exemption limit. Once if the income is getting assessed at 3.5 lakhs, let's say, and the basic exemption is 2.5 lakhs, immediately the provisions of 270A would get attracted in terms of subsection 2. It will fall within the definition of underreported income. Then income reassessed is greater than the income assessed or reassessed earlier. That is in the context of a second assessment being carried out. Then the similar provisions for MAT. Same three scenarios for MAT. In the event of filing the return of income, deemed income is assessed is more than the deemed income processed. Then in the event of not filing a return, deemed income assessed is more than the basic exemption limit. And again, the last scenario where there is a second assessment. Now this last limb, that is the seventh limb, talks about a scenario of reduction of loss or a conversion of loss into an income. So even in the context of an addition being made in the context of in reducing the loss will again fall within the ambit of underreporting of income. Now subsection 3, before I go to subsection 3, in subsection 2, basically there is one interesting aspect here. Everywhere the starting point in the event of filing a return of income starts with 143(1) and not with the return of income file, which means the adjustments made under section 143(1) is not within the ambit of 270A. Any adjustment, automated adjustments, which is done by CPC Bengaluru based on the scope of the 6 adjustments which they are permitted to do, all those 6 adjustments would not fall within the ambit of 270(A). So the penalty cannot be levied for such adjustments made by CPC Bengaluru. Now, how to compute this underreported income? The subsection 2 talks about the scenarios where underreporting of income is there. Once there is an underreporting of income, it has to be computed based on this formula. Basically, the formula is nothing but the just to quantify the addition or variation made. If return of income is filed, it will be income assessed minus 143(1) processed. Again, the starting point is 143(1). In the event of not filing a return, the company, firm, and local authority, there is no basic exemption, so it will be flat at income assessed. In case of the other person, it will be minus the basic exemption. And in the event of subsequent assessments or any other case, the residuary clause, it is being calculated by income assessed minus income assessed in preceding order. So the first assessment, the amount quantified is 100, and the second assessment is 140. The reassessment is 140. The penalty proceedings initiated under reassessment can be limited only to that 40 rupees, not to any of the additions made in the first round of proceedings. With similarly for MAT, there's a specific formula given where they quantify the general provisions and the MAT provisions, and the underreporting of income is being quantified. With respect to subsection 4 and subsection 5, it is basically a replica of what was stated in explanation 2 to 271(1)(c), where the source of any receipt or deposit or investments in any year is claimed to be an amount added to income or deducted while computing loss, as the case may be in the assessment of such person in any year prior to the assessment year, in which such a receipt and no penalty was levied in such year. Then underreporting of income shall include such amount as if sufficient to cover such receipt. So basically, the explanation which was introduced in 271(1)(c), explanation 2, was again captured in this 270A subsection 4 to specifically include that scenario. And subsection 5 also talks how in what manner that has to be computed. That is first preceding year will come first, and then the earlier years. Next is a crucial limb subsection where the exceptions are being carved out in 270A. Now, let's assume the 270A2 gets attracted. There is an underreporting of income. Still, whether it can be said that it will not fall within the ambit of this penalty provisions. For that, there are specifically 5 limbs stated in subsection 6, where all, if the conditions are satisfied, it can be construed as an exception to this penalty. The first limb is bona fide explanation given by an assessee. Basically, that here there needs to be 3 conditions to be satisfied. One is the assessee has to offer an explanation with respect to that addition or disallowance. Second, the explanation offered by the assessee has to be a bona fide one to the satisfaction of the AO or CIT appeals. Third, the AO or CIT appeals or PCIT should be satisfied that all material facts are disclosed by the assessee. Only if all three conditions are satisfied, then it will be treated as an exception. Second scenario is an estimated addition. Here, the estimated addition is basically a scenario where the AO has estimated, the addition is being made by an estimated made by the AO, and still the accounts are being properly maintained, are complete to the satisfaction of the AO, and the AO is satisfied that the income cannot be properly deduced by the method employed by the assessee. Only in such event, the particular limb can be invoked to say that it falls within the exception. So, in the scenarios where AOs estimate the income, where the assessee has not furnished its books of accounts, or the books of accounts furnished by the assessee has been rejected by the AO, the assessee would not be able to harp on this limb to claim exception. The third scenario is a very interesting scenario where the assessee himself offers it at a specified rate, let's say at 5% profit, and the AO determines it at 8%. And the variation, whatever happens there, will not be subjected to this provision as long as the material facts are already reported in the return of income. So I think the third limb is even more liberal compared to what the second limb is, because second limb, despite me maintaining the books, there could be a reason why AO was estimating it for various reasons. On that ground, I would not be entitled for the this exception until the AO is satisfied that my books are correct. So even in the event of rejecting my books, I would not be entitled. Whereas in the second event, where the third event, where I myself have estimated it and the AO estimates at a higher figure, I would be entitled for this exception. And fourth is a scenario where an addition has been made in conformity with an ALP determined by TPO. Then if the assessee establishes the fact that he has maintained information and documents under section 92D and declared the international transaction and disclosed all material facts, despite the addition made in conformity with the ALP determined by TPO, penalty cannot be levied for such addition. The last exception is 271 AAB. As I have already stated, the natures of income, different natures of income. Undisclosed income is a specific income which is being quantified in consequence to a search conducted. And such an income, once an income falls within the definition of undisclosed income, either in the search year or 1 year prior to that, then the same cannot fall within the ambit of underreporting of income for the purpose of levying penalty under section 270 capital A. So these are the 5 exceptions that has been carved out in 270A. Subject to the fulfillment of the conditions, the assessee can take advantage over these exceptions. Subsection 7 and 8 talks about the rate and quantum of penalty to be levied. Again, subsection 7 talks about a scenario of underreporting of income, where 50% of the tax payable on underreporting income as computed under subsection 10 will be levied. Now, subsection 8 is very crucial, because in subsection 8, it is a non-substantial clause where the subsection 6 and 7 are being overridden. Notwithstanding anything contained in subsection 6 or 7, where underreporting of income is in consequence of any misreporting thereof by any person, the penalty referred to in subsection 1 shall be equal to 200% of the tax payable under reported income. So the tax levied on misreporting is 200%. That is not an issue. That is one aspect of it. The larger aspect of it is the exceptions, which I have discussed now. The 5 different exceptions are being will not be applicable, or the assessee cannot take shelter on those exceptions in case the AO gives a finding that the assessee falls within the definition of underreporting in consequence of any misreporting, which is captured in subsection 9. So once I fall under subsection 9, I cannot take any shelter under underreporting. Now, subsection 9. Subsection 9 starts with the word cases of misreporting shall be the following. So, which means these are the identified scenarios of misreporting, which is not an exhaustive list. It is a very specified list which has been pointed out in subsection 9. If it falls within these 6 limbs of subsection 9, then it can be said that the underreporting is in consequence of misreporting. First limb, this is on the misrepresentation or suppression of facts. Basically, misrepresentation would has to be examined on a case-to-case basis, which would involve a scenario of representing or false facts, which is being material for making a decision. Similarly, suppression again would involve an action of keeping a secret or a refusal to disclose or reveal a material fact, which would alter the decision, would again form within the ambit of suppression of facts. There is also one decision where they have discussed the suppression to state that suppression always implies a willful non-disclosure. So here again, there should be a willful attempt by the assessee to not disclose it or not reveal the actual fact. In such an event, if the AO is able to establish the fact that there is a misrepresentation of fact or a suppression of fact, then the AO can ensure that the penalty is being initiated under 270A subsection 9 and ensure that there is no exception benefit or the immunity benefit given to the assessee.
இது போட்டாதான் காதல விழும் போல இருக்கு. இது போட்டாதான் காதல விழும் வந்துட்டு வீட்டுக்கு போய் மேல கண்டினியூ
Mr. Sridharan, please mute yourself.
போய் போட்டு
Mr. N. Sridharan, please.
Mr. Sridhar, please unmute. Please mute, brother.
Please mute Mr. Sridharan. N. Sridharan.
வாசு நீ கோ-ஹோஸ்ட் நீயே கூட மியூட் பண்ணலாம்பா.
ஆனந்த் மியூட் பண்ண.
வாசு கோ-ஹோஸ்ட் பண்ணு.
போட்டு.
Continue, Arjun.
Yes. So 270 subsection 9, this talks about misrepresentation and suppression of facts. Next limb talks about next 4 limbs. Basically, there are totally 6 limbs. So the next 5 limbs talks about the scenarios where an assessee is not reporting a particular transaction in its books of account or reports a false transaction. Then the instances of misreporting gets attracted. First is the failure to record an investment in the books of accounts. Then a claim of expenditure not substantiated by any evidence. Then recording of any false entry. Failure to record any receipt in the books of accounts. And last is the failure to report any international transaction. Here, the one aspect is failure to not recording a transaction or failure to recording a false transaction. Now, the crucial limb would be clause C, which says claim of expenditure not substantiated by any evidence. Now, the other aspect would be what would be an evidence for substantiating that expenditure. Because in various cases, I would provide before the AO the self-made vouchers for payments made to labor, which according to the assessing officer could not be an evidence for substantiating such claim. So again, this clause C is a wider scope. Again, it would involve a lot of interpretations to say what evidence would substantiate the claim of expenditure in order to either fall within the ambit of clause C or to fall outside the ambit of clause C, depending on which the underreporting or the misreporting will get attracted. Now, with respect to 270A subsection 9, again, as I've started saying, the intention of the lawmakers was to categorize it into a small wrongdoing and bigger wrongdoings. Now, the underreporting under subsection 3 and which has the benefit of exceptions and immunity falls as a small wrongdoing, while these instances mentioned in subsection 9 would fall within the ambit of bigger wrongdoing for which no benefit of exemption or immunity is being granted. Now, coming to the tax payable on underreporting of income, because based on this computation, the 50% or 200% is being calculated. There are 3 different scenarios captured here. One is scenario where no return of income was filed or return is filed in consequence to 148. Second is a scenario where return is filed, processed, and 143 or 141 is a loss. Third is any other scenario or residuary clause. Again, here the intention of the lawmakers is to identify the tax to be levied on the assessed income after making an addition and the scenario where tax
இது
has to
ஸ்கேன்
be
பண்ணி போடுமா?
Rajendran, unmute பண்ணீங்க. Mute பண்ணீங்க.
So in this scenario where a return is not being filed, it will be tax paid on the assessed income has to be calculated, and tax on chargeable tax has to be reduced. Next is the scenario of income assessed in preceding order and 141 is a loss, where the difference of the additional tax on the assessed income minus the tax on the 141 income would get attracted. Any other scenario is a formula based, where they specifically says that the tax on the assessed income minus a tax on the reported or the processed income will quantify the tax payable on underreported income. The main reason for doing this is to just push the assessee to the highest slab rate and then quantify the tax payable on underreporting of income. The last two subsections in 270A are subsection 11 and subsection 12. Subsection 11 talks about a scenario where, to avoid a double penalty. Basically, an addition or disallowance which has already formed part of an imposition of penalty shall not be again levied for the same person or for any other assessment year, to avoid the double levy of same penalty on same addition or disallowance. And last subsection 12 talks about the persons who can pass this order. It is assessing officer, CIT appeals, or the jurisdictional CIT, jurisdictional PCIT, who has to pass an order in writing levying this penalty under section 270 capital A. Now I just discussed the various subsections being captured under 270A. Next is the question whether this 270A would amount to whether it is mandatory or discretionary, whether the assessing officer has a power to draw penalties under 270A. There are various decisions defining and interpreting the terms may and shall. Where they say once the word may has been used, it has to be construed as not automatic. There is a discretion vested with the assessing officer. And I have also captured the section where which is very much similar to what was there in 271(1)(c). The very same language in 271(1)(c) has been used in 270A. There are various decisions. It says 271(1)(c) is not automatic. Discretion is vested with the officer to decide whether it is a fit case or not a fit case. Again, on the other facet of it, the intention of the lawmakers was to reduce the discretion vested with the assessing officer. And in this context, there is also a decision of Supreme Court where they say the question as to whether a statutory provision is mandatory or directory would depend upon the statutory scheme. It is now well known that the use of expression shall or may by itself is not decisive. The court, while construing a statute, must consider all relevant factors, including the purpose and the object the statute seeks to achieve. So it has to be read along with the intent of the lawmakers. There is also another recent decision rendered in 2018, that is after the insertion of 270A. In the context of 271A-B, there was an Allahabad High Court decision where they have stated that the penalty levied under 271A-B in consequence to a search, once the search has been conducted and there is an undisclosed income, the penalty would be automatic. So this particular decision was also affirmed by Supreme Court by way of dismissing the SLP of assessee. And under the judgment of the High Court, they have stated that once search has been conducted and once the undisclosed income has been identified and quantified, the quantification is procedural, and but the levy of penalty would get attracted automatically. Before going to this conclusion, there is another aspect which has to be seen as the intent of the lawmakers. Lawmakers here have categorically stated that they wanted to reduce the discretion of the assessing officers. But to what extent they want to dilute it? Because there is a specific finding in the speech stating they wanted to reduce the discretion of the assessing officer deciding the quantum of penalty, whether 100% to 300%. And they wanted to have a graded penalty. So the next question which comes to discussion is, what will be the dilution here? Whether the lawmakers wanted to dilute only the quantum of penalty, because now it is certain. Now it is either 50% or 200%. There is no scope for the assessing officer to levy any other rate. Once it falls under underreporting, it is 50%. And if it falls under misreporting, it is 200%. So according to my understanding, the dilution of the discretion of the AO would get restricted only to the extent of rate of tax. And still, since the word may and the words as per 271(1)(c) has been replicated here, the discretion is still with the assessing officer to decide whether to levy penalty or not. Next is another new concept which was introduced under this new regime, the concept of giving immunity to an assessee from penalty and prosecution, with more of a settlement from him, with a guarantee that he would not file an appeal and create a litigation against the assessment order. So here there are a few conditions to be satisfied by the assessing officer, to be satisfied by the assessee in order to be entitled for the immunity. First condition is that as and when he receives an assessment order, he has to accept that addition and pay taxes on that addition, whatever the tax being quantified in the demand notice. He has to pay the taxes within the stipulated time mentioned in that said notice. So as and when he pays his tax, first condition. The second condition, he should accept that addition. He should not file an appeal against that assessment order. And the third condition is a procedural one. After paying taxes, after not filing this appeal, within 30 days, he has to file a declaration in Form 68 to the assessing officer, stating that he has paid the taxes, giving the challan details, and giving a declaration that he has not filed an appeal against the order. In the event of complying with this condition, he would be entitled for an immunity from penalty as well as prosecution. Interesting factor here is this 270AA is not available to a person who has been whose income is supposed to be underreported in consequence of a misreporting. So in such an event, the AO gives a finding or initiates the penalty proceedings by invoking 270AA subsection 9. Then there cannot be, the assessee cannot claim immunity under this section 270AA. There is a specific bar in 270AA for people, when additions made in consequence of misreporting. And the other aspect in 270AA, as and when I file an application, the AO shall grant immunity subject to the fulfillment of conditions. So there is no role for the AO to either accept or reject my immunity. Once I satisfy the conditions, he shall grant me immunity. In the event of not satisfying the conditions, the AO can reject it after giving an opportunity to the assessee. Now, the immunity is being granted from levy of penalty under section 270A. That is a levy of 50% on the tax of underreported income. And similarly, the immunity is also granted for prosecution proceedings to be initiated under section 276C or 276CC. And to get this immunity, the assessee has to waive his right of appeal under 240 and waiver of right of revision also. Once the immunity has been granted, the assessee shall not or will not be able to file any appeal or revision petition before the appropriate authorities. Next, another interesting circular issued by CBDT is with respect to this settlement being done under this Form 68. They have categorically stated that just because I have furnished this Form 68 on a particular issue for a particular year, that would not amount to concession on merits or giving up the right on such addition for the other years. The similar addition made for the other years, I can independently file an appeal and I can object to it. The Department of the Revenue cannot state the earlier year filing of Form 68 to conclude that the assessee has accepted the addition. Next is one interesting issue here is generally there are various additions made in an assessment order. There could be an addition in the context of a deeming provisions, that is in the context of 271 AAC penalty being initiated for an addition made under 68 or 69 or 69A or other deeming provisions. And there will also be a simultaneous addition made for underreporting and 270A is being initiated. Now the question is whether I can I accept one addition and will I be entitled for the immunity under 270AA because I have not challenged the addition on which 270A was initiated. And in the event of complying with the other conditions, that is paying taxes and complying with Form 68, will I be able to get waiver is the crucial aspect to be analyzed. But according to my understanding, the provisions of 270AA talks about the not challenging an order. So it should be considered as order specific and not an issue specific is my understanding. Subject to, I hope I'll get different ideas from the people at the end of the presentation. So this is with respect to the immunity granted. Next is with respect to 273 capital A. There is another section which was, in fact, I had not known about this section until I prepared this presentation. This section talks about a waiver or a reduction of penalty. Here, this was there even in the context of 271C. And after 270A was amended, this section is also being amended to include 270A. Here, there are few conditions. The first condition is there should be a detection by, prior to the detection of AO, there should be a voluntarily disclosure by the assessee. That is the first condition. Second, he should have cooperated in an inquiry. Third is satisfactory arrangements that should be made for payment of tax. One good thing about 273 capital A is it doesn't distinguish between 270A, 270A3 or 270A9. So even in the context of misreporting, there could be a case made out for waiver or detection, subject to the other conditions being satisfied. Second scenario is, second is the fact that this waiver or reduction, you don't have to waive your right of appeal. You are just asking a waiver or reduction of penalty after the penalty is being imposed. That is other advantage. And again, here from prosecution under section 276C and 277 are being granted if the waiver is being entertained. Immunity is being granted. So these are the relevant provisions. Apart from this, there are few sections which will overlap with this 270A. For example, 271A-B deals with undisclosed income for search, in which case 270A cannot lie. Similarly, for deemed income, in the event of 271A-C getting attracted, 270A shall not lie. This is one interesting section which I could, provision which I could lay my hands on, wherein I noticed that 5627B, there was a specific exception given for venture capitals. And also another specific limb introduced for notification issued by central government to exempt certain people. Wherein in various notification, various conditions are being prescribed. So this was a proviso to 5627B, wherein they have stated, in the event of any violation of such conditions specified in the notification, it shall be deemed that the company has underreported the income in consequence to misreporting. So this is a specific provision which is not there in 270A, but with this, which is with respect to a specific provision, if it gets attracted, it would amount to misreporting. And similarly, there was a new section in 2022. This was introduced in 155 subsection 18 with respect to the dispute of claim of surcharge assess. This is even more interesting, where they have stated surcharge assets, which is not allowable as deduction under section 40, has been claimed and allowed in the case of an assessee in any previous year. Such claim shall be deemed to be underreporting of the income for such purpose, notwithstanding anything contained in subsection 6. So the exceptions carved out in subsection 6 also cannot be harped into in this scenario. So the and the AO is also being given power to pass 154 order. So this is a specific scenario where this 270A has been deemed to be getting attracted. Just before I get into the case laws, now just a comparison of 271C and 270A. Now the discretion, whether it is still there, the wordings used by used in 271C and 270A are similar. So in my understanding, the discretion to either initiate or to drop it is still available with the assessing officer. Second, with respect to rejection of mere explanation or rejection of explanation given by the assessee, again here 270A subsection 6, the exceptions are there where a bona fide explanation can be considered as an exception. But the problem here is the statute has created various conditions that the assessee has to satisfy in order to claim that exemption. That is another crucial aspect, the crucial change brought in 270A. And the lack of precise charge, I presume that it can be, again, that issue can crop up in the context of misreporting, under which limb, and whether it is only underreporting or also misreporting, that issue might crop up depending on the facts and how the system. Now it is all being generated through, automatically generated through electronic regime. So whether there will be any issues or not has to be seen on how things operates. Next, The estimated addition is again, there are certain conditions being attached to that. So how that has to be seen is has to be analyzed based on case to case basis. Now, there was a concept of proved and not proved and disproved. I don't think that will operate now, because now it is being a formula based quantification. So the concept of proved or not proved or disproved would not get attracted now. So next is the few case laws which I could. Sir.
Excuse me, Arjun.
Yes, sir.
I think time for you to wind up.
Okay. Yes, sir. I just wind up another 2 minutes, sir.
Yeah.
I just wrap it up. I just captured 3 case laws where this 270A has been adjudicated. There was one case where the DVO has valued it under 43CA. They say the valuation would amount to an estimate and 270A will not get attracted. And Delhi High Court, there are various case laws where they say the procedure has to be fully complied with while granting an opportunity to the SC either to reject or not to reject, even in the context of underreporting. And the other aspect is 270A subsection 9. In case the AO invokes 270A subsection 9, he will have to specify which limb it falls into to call it a misreporting. Only then the assessee shall be denied of that immunity. Next is again the 270A. This is the lead case of Delhi High Court, which was followed in subsequent years. So I think this is my presentation. If there is any questions, probably
we'll take 2-3 questions.
Yes.
Vasu, I will first, as a president, I have the right to.
Sure, absolutely. As a senior, you have a question in.
You have a right to attack me, sir.
The first question, just 2 questions, fundamental question. Yes. The assessment, the completion of assessment is the starting point for granting of the immunity under 270 capital AA. That is the starting point. Assuming for a moment, in the assessment order, the officer says that it is a case of a misreporting, in consequence to underreporting, etc. You will lose the benefit of that the 270 AA immunity. How to challenge that finding in an assessment order? Are you entitled to file an appeal against that finding also as part of the assessment order? If you file the appeal, you lose that benefit of the immunity. How to tackle that situation?
In such a situation, probably, in my opinion, the right approach would be to file a Form 68, claim it as underreporting according to the assessee. Obviously, the assessing officer will reject it on the ground that it's misreporting, and we can file an appeal or a writ against that penalty order, not the assessment order. Because once we file an appeal against the assessment order, my right of getting an immunity goes off. So it would be advisable to file Form 68 within the stipulated time, pay taxes, and question only the limb whether it is underreporting or misreporting during the penalty proceedings.
Question number 2. There are conditions for 270 AA immunity, getting immunity, assuming I make some mistakes, procedural mistakes. Namely that I have not filed that Form 68 electronically. I suppose that is one of the conditions for the filing the form electronically. Yes. What are the consequences?
Basically,
how to tackle that? How to get that benefit of immunity by getting over the procedural irregularities committed by any assessee for that matter? Yes.
There are 2 things. One, let's say for a moment that we have violated the 30-day time limit and Form 68 has been rejected. As I have already stated, we can either go for an appeal or writ, and then the first appellate authority or the High Court has jurisdiction to decide whether it is directory or mandatory. The other approach, a safer approach, would be to go before the board under 192B and ask for this continuation of delay in order to grant an immunity.
Thank you, Arjun, for the answers.
Yeah.
Yes, sir.
Yes.
Any other questions, please?
Any other questions? Yeah, I think we are done.
Yes.
Thank you, Mr.
I
Arjun.
have a question.
Yeah.
In 270A(11), you said if penalty is imposed under any, if a penalty is already imposed, you cannot. Will that cover penalties under all other sections also?
Here, it's the wordings used here, ma'am, is 270A subsection 11 is imposition of penalty under this subsection.
This subsection.
under
So
this subsection.
why
So
would there be two,
No, there could
two
be a scenario.
proceedings? Where do you envisage two proceedings under the same section?
There could be a scenario where addition is being made either for the same person in different assessment years or for different persons for the same issue on same year. The 270A will automatically get initiated for underreporting in the respective hands. Probably in that scenario, once 270A has been levied in a particular case, the same cannot be repeated. In order to avoid that double taxation, the subsection 11 has been introduced.
And 273A waiver or reduction.
Yes.
The word used a waiver or reduction.
Yes.
He could even reduce it marginally by 5-10%.
Yes. That is.
What's the point?
No, that is within the discretion. The one
There's
advantage
a huge
there is.
amount of discussion given.
Yes. The only advantage here is if I'm being treated as misreported income, 278(9) gets attracted. I don't have an immunity right. So I would
this
go
is
for
the
an
only
appeal.
this is the only choice.
Only remedy. I'll go for an appeal and simultaneously pursue this remedy.
Okay, thank you.
Thank you, Mr. Arjun.
Yes.
You've done it very elaborate.
Vasu sir, Vijay sir, can I?
Yeah. Yes.
Hi Arjun.
Hello, sir.
Arjun, I have a question.
Yes.
An assessment was completed by estimating the total income. This happened in the central circle. Thereafter, penalty was initiated under 270A(9).
Yes, sir.
Is this right?
I hope I'll get some professional fee for that, sir. On a lighter vein, sir. Sir, but again, as I told, sir, we'll have to challenge this initiation which was done as misreporting. We'll have to file, the assessee has to file a Form 68 stating, take a stand that it falls within the exceptions. And we'll have to challenge during the penalty proceedings, either before the first appellate authority after the penalty order is being passed, or before the High Court through a writ, and then get a remedy.
Mr. Arjun, the answer to my friend's Vijay's question, what is the SCN states? So if you are disputing the SCN, the stand taken in the SCN, you have to counter it at the SCN stage itself.
Both during the
If
penalty
you fail to
proceedings
take
and-
that the objections at the SCN stage, you are out.
Yes. Right from day one, we'll have to object it.
Yes,
Good
sir.
evening,
Yes, sir.
Arjun.
Thank you.
This is
Thank you.
Vishwanathan.
I think we are running out of time for Arjun. We'll have
One more, please, Secretary sir. One more question.
Okay, yeah, right.
Arjun, good evening. I want one scenario
Yes, sir.
where the assessee relying on a particular case law.
Yes, sir.
Say, for example, deduction under 14A.
Yes, sir.
He is relying on a particular case law. The matter is still pending, say, in High Court or in Supreme Court. Whether in this addition, whether 278 can be still be levied.
In fact, sir, there was one Delhi High Court writ scenario where a similar edition of 14A was challenged. And the Delhi High Court stated that notional addition of 14A would not fall within the ambit of in that case, in fact, it was stated to be a misreporting scenario. So they have given a finding specifically with respect to 14A stating this will not fall within the ambit of misreporting. But again, underreporting, we'll have to see how to defend the case, depending on how the quantification has been made on a case-to-case basis.
Okay. Okay. Thank you.
Close it.
Yes, thank you, Mr. Arjun.
Thank you.
Very
Thank you.
elaborate session for you.
Thank you.
Was
And-
there only one question was there? Is it okay?
Right, okay,
Small-
yeah, final question, yeah.
Yes, sir.
See there. Arjun, Form 68 is filed in time. Is there any
Yes.
time limit for passing the order from the assessing officer? And if it is not passed, where I stand? If it is not passed in time.
If
I
it
was-
is not passed, it is better to assume that the penalty has been dropped, sir, because we don't want to rake it up from our end. But generally, there should be an opportunity given if he is rejecting it, sir. If it is accepting it, there need not be any opportunity given. Generally, but to the best of my knowledge, the orders are not being passed within the span of time, reasonable time.
What's the time limit? There's a time limit also, right?
Yes, there is a time limit specified in 270. 1 second, sir. 270 AA, there's a time limit to pass an order.
14 days, sir.
After the expiry of the time period filing appeal.
30 days.
1 month from the end of the month in which application is being received, sir. So there is a time limit specified, But again, it's more of an internal process, because as long as it is not rejected, the ASSI need not be given an opportunity. Once you again receive a notice, then you will have to object to it.
No, sir. I mean, Form 68 filed 1 month, lapsed. See whether the ASSI is, has been given immunity. Can that be an assumption?
Deemed to be accepted, sir.
Okay. Thank you.
Thank you, sir.
Thank you, Mr. Arjun. It's been a very elaborate session by you.
Thank you.
Taken through the entire provisions of the system, but still a lot to be discussed on this.
Thank you.
Now we move to the next topic for the day. That's on the GST. Mr. T.R. Srinivasan, Chartered Accountant, is here. He's going to start this session of 12 topics. Today is the first topic on taxable event and GST and levy conditions. I'll just give a profile of Mr. T.R. Srinivasan. He is a gold medalist in BCom from Vivekananda College and all India rank holder in ICAI. And his professional background is really astounding. He's a fellow member of the Institute of Chartered Accountants of India for the past 13 years and also insolvency resolution professional. He's a partner in NV Balaji & Co., focusing on matters related to risk advisory, goods and service tax, customs and foreign trade policy. He has his association extended in many forums. He's a member of study group for implementation of GST in ICAI and certified trainer of NACEN, Government of India for GST, trainer for the offices of income tax, GST, customs and CAG. And he is a speaker at various forums. So we have Mr. T.R. Srinivasan, and I think we have a very apt person to make us understand the nitty-gritty of GST.
Vasudevan, before Mr. Srinivasan commences with his presentation,
Right.
My friends and my members, we have structured this the presentation of Mr. Srinivasan over the period of next 12 months and on the various topics on GST. So every month we will listen to Mr. Srinivasan's acumen under the GST laws. So I think he has given certain topics that will be useful for practical purposes. And my request is please don't miss all these 12 study circle meetings coming up. This is the first one. So Mr. Srinivasan, we can start.
Yeah.
At the outset, I thank RBI for this opportunity. So it's also my pleasure to be presenting my thoughts about GST. Of course, normally we say that, between life and death, there is life. And between birth and death, there is a life. But then we also have GST coming along every day. So right from morning, starting up till the day end, only one person who comes along with us, along with our good deeds and bad deeds, is the GST. So, of course, we are now about close to 6 years getting over. And probably this is the time where, litigations have started coming up right, left and center. Though there are litigations coming up primarily on constitutional aspects and more on procedural violations, the technical issues and litigations have cropped up very recently. The government's, just to give the context of where we stand, presently we are looking at, the end of this year as the timeline for passing the assessment orders relating to the very first year of implementation of GST, which is 17-18. So for 17-18 financial year, the time limit to conclude the adjudication and pass the order is 31st of December 2023. So we are looking at roughly about 5.5 years later, which is the normal period of assessment. Then we have the additional enhanced period of assessment, like the extended period of limitation, which will run up to 2025. So it means that, even for the first year, we are looking at a time frame of about 8.5 years of gap. And it means you can follow it up with subsequent years. Every period, there is a 3 years and plus 5 years. That's the timeline they have fixed. So effectively, probably this could be the right time to understand the technical aspects of GST and move forward in technical direction. Of course, most of the topics are, giving a broad cursory look, and some of the key issues in the topic would be highlighted. Maybe more specific in detail as we go along, we can discuss. So most of you would be largely aware of GST, of course. Then now, of course, key points which I would like to touch upon today. The first topic is on when GST would come, which is by itself the biggest topic in any taxation provision is the charging section, which itself can be elaborated for quite a number of sessions. But then some of the key aspects I would cover. The first or the underlying principle the GST wanted to focus is the destination-based tax. That is, in the erstwhile law, whatever revenues comes in a taxing provision, it goes to the originating state. Basically, let's say a CST sale, interstate sale happening from Tamil Nadu to Maharashtra. Earlier, they were levying CST, Central Sales Tax. That money was going to the Tamil Nadu government, origin state, where it was produced. Whereas now in GST, it goes to the destination state where it gets consumed. That means in the same example, post GST, the money goes to the Maharashtra, that is Maharashtra state. So effectively, the states had some level of reservations about their tax collections, and hence they had this compensation cess, which was promised for a period of 5 years. So that was the initial agreement. Of course, state wanted an extension of the compensation cess, because the underlying calculation is you have to take the 15-16 or 16-17 tax collection data, and we have to assume an increase of 14% year-on-year tax collection growth. This is the formula they have defined. And if any state gets less than this, naturally there has to be an offset, and that's the compensation cess they are levied. So there was a GST compensation cess which has been guaranteed for 5 years. And of course, the 5 years got over, 2022. There have been requests to extend the guarantee given by the through way of cess, which has not been, decided upon, or I would say has not been considered yet. So as on date, there is no further guarantee given. So as of now, every states have to be self-sufficient now in terms of managing the tax revenues within the broad framework of the GST, right? So the first thing is destination tax. There are cases where this underlying destination tax principle gets defeated upon. For example, there are some cases where it is not destination, it is based on origin. So, who decides whether a particular, supply, that is transaction should be collection based on destination or origin, is called place of supply. We call it as place of supply. And this is decided by the central government. Constitutionally, the powers are given to the central government to decide about the place of supply, which comes under the separate law called IGST Act. So there have been disputes about how to decide the place of supply. Recently, a Bombay High Court judgment has come that it was a split decision of the High Court, went up to the third member. And hence, the end of the day, what has happened? Place of supply ultimately is within the scope of the central government to decide. That is whether it should be destination based or origin based. Conceptually, it has to be destination based, but legally speaking, whether it is destination or origin is something which central government will decide based on its powers given under the IGST Act, which has also been upheld by both Gujarat High Court as well as recently as Bombay High Court also. So first point is destination based tax. Second, compensations is, as I said, to compensate the state revenues, which has been discontinued. Many states, there are a few states which has probably lost revenues because of the shift in the consumption to, origin to consumption, that we will maybe go along. What taxes we still continue to have? As recently as yesterday, there have been a Patna High Court judgment. What has happened is many of the taxes or indirect taxes have been eliminated upon, that everybody is aware. So I'll just touch upon few important aspects regarding this. So which means presently we still have excise duty. It is being levied, but excise duty is levied on specific products. So we still have excise duty on tobacco products. It was challenged in High Court, but the levy was upheld by the High Courts also. So excise duty continues as on date for tobacco related products, and also for, alcoholic liquor for human consumption. It is constitutionally outside the scope of GST itself. So that is the first one. Then we continue to have electricity tax or property tax, other things, it's very clear. The most importantly, something related to entertainment. You find cinema tickets. And in cinema tickets, you have GST. And earlier they said up to 100 rupees one rate and more than 100 rupees another rate. So many confusions happen. But then there is GST for cinema tickets also, like any entertainment, amusement parks, etc. Any entertainment activities. Now, what happened? State government does not have powers to levy any other taxes other than the GST, because both union and state now join together and levy it. So the power has now been given to the local bodies to levy the entertainment tax. Local authorities, the panchayats, the municipalities, the corporations have been empowered to levy entertainment tax on the entertainment activities. It means cinema ticket can continue to have a GST plus entertainment tax also. Of course, recently, yesterday, Patna High Court gave a judgment that entertainment tax levied post-implemented constitutional amendment was done through 101st Amendment, which brought in the GST enabling provisions. After that, the Patna High Court said no entertainment tax can be levied by the state. Absolutely correct, because states cannot levy the entertainment tax anything forward because there's no power now. But local authorities, you can find here, entertainment tax can be levied by local authorities. So that powers continues to exist, and probably people, the authorities keep it as a tax, revenue generation mechanism for local authorities or funding local authorities, etc. So to sum it up, we continue to have excise duty for certain products, and we continue to have VAT for these products. So we can find petrol, diesel, natural gas, aviation turbine fuel, crude oil. All these things have VAT being levied and excise duty, central excise duty being levied. And of course, alcoholic liquor is for human consumption alone, is completely outside the scope of GST as per the constitution. So it means for these products, it is there within the constitutional framework to levy GST. As of now, GST Council has not recommended the petrol related products into GST. Whereas alcoholic liquor for human consumption is a strict no. You can't even bring it within GST. It is even kept it outside the scope of the constitution itself. So there is constitutional amendments made. Very interestingly, you will find a lot of these are the key articles where the constitution amendments have been made. So 246A, both parliament and state legislatures have been given powers to concurrently levy GST on goods and services. It means the parliament is saying, in fact, the wording used is supply of goods and services. You will find Article 366 of the Constitution, which said GST is a tax levied on supply of goods and services. So the focus is on 2-3 words. One is the word supply. So the taxable event is very clear, supply. And what should be supplied, either a good or a service has to be supplied. This is what they have mentioned. One interesting point, they have defined what is a good. You can find 66B. Services means anything other than goods. Simple definition. So now the next is goods includes all materials, commodities. This is a standard definition which was already available. But they have not defined what is a supply. So it means constitutionally there is no definition for the word supply. The word supply has been defined in GST law only. There is no, even the definition is quite broader. But in Constitution, it empowers GST to be levied on supply of goods or services. But the word supply underlying has not been defined in the Constitution per se, in the context of GST. So it is probably, it is coming only in the Act, the GST Act per se. And goods and services, of course, there's a definition given in the law. And this definition, which is given in the Constitution, and the definition of goods and services given in the Act changes. Now, does it matter that now they said that, goods and GST merges one nation, one tax, so there is no distinguish between goods and services, because earlier, we used to have parallel jurisdiction. State taxes, VAT will also be levied on some transaction. Service tax may also be levied, like hotel, food, restaurants, you will find both being levied. Construction, we had these challenges. Then we had challenges on leasing of transactions. Some state laws deem it as a deemed sale on certain conditions. Then service tax was also levied, treating it as renting of property, renting of goods. So we had parallel jurisdiction. And some cases we didn't know whether it is a good or a service or a combination of both. So both authorities started levying a lot of disputes litigation. So post GST, the thought process is it should ideally not be there. However, Post GST also, we continue to have the distinction between goods and services maintained. Why it is important? Because the time of supply, when you pay the tax will change. The rate of tax may change. The value may change. The documentation procedure changes. The movement procedure changes. Invoicing. So effectively, we still have to know what is a goods and what is a service in the context of GST. And that definition is given here. It says goods include all materials, commodities, and articles. But that's the definition here. And constitutional definition, which is there in the constitution, and GST specific definition in the law is different. So one underlying observation is GST supply is not defined in the constitution, though it is there in the constitution. And more importantly, the interstate law. So you can find article 249 A, so or 250, or also the article 246A. It says anything interstate from one state to another state, it is the scope of central government to levy taxes. So it means central government will decide for one state to another state. Within the state, it will be governed by the respective central government, and state governments will be there. And there have been disputes on one important thing, that, okay, so we have a federal institution. I think there was a very, very popular judgment, very recent, I would say a year back, on the federalism nature of the GST, and whether GST council is there. You will find in many cases practically, though that may not be the right approach to do, that you get a press release even before the law has been notified, saying that this is the revised procedure. Or you will find a circular getting released before the notification. The notification comes a little later. And probably there's a central government circular comes on clarifying a particular issue, conflicting with the state government view. So there are, all these initial, I would not say the word initial, all these contradictions are there presently as regards to the GST law is concerned. But underlying law, the underlying thing is whatever the levy is being done, a product rate, whether it should be 5, 12, 18, 20, whatever be the rate, they fix. This rate is probably governed by the unifying authority called GST Council, and GST Council gets its powers from the Constitution, and that is where the there was a huge discussion happened in a recent judgment. It was in the case of Mohit Minerals Supreme Court judgment. That was in a different approach, challenge altogether. But then, incidentally, the Supreme Court, made a very detailed observation about the powers of the GST Council. And there they said GST Council, because the law says GST Council has to recommend for the changes, for the amendments to be done, etc. So the question is whether everybody is governed only by GST Council, or can states take an independent view on this matter or any matter, etc., or whether they are only bound by that. So the Supreme Court made an observation: GST Council is it's formed under the Constitution. However, it is only a recommendation and may not necessarily be binding for every situation. So there have been, in fact, a political debate, a constitutional debate surrounding the GST Council and its recommendations, whether any state governments can go out of the purview of the GST Council in implementing their own rates if they would like to do. As of now, let's say, for example, you will find that in Tamil Nadu, if you keep a film name in Tamil, they used to give exemption in earlier law, because they used to give either a VAT exemption would have been given, because that was the prerogative of the respective state governments, because VAT was completely under the state government's control. Now, post GST, that kind of facility has not been there. So because all state governments now follow a reimbursement approach. That is, if a film name is kept in Tamil, the SGST portion, they reimburse it back. Whatever they collect as SGST, they reimburse it back to the consumer. How they do it, etc., and all is another mechanism. But then they are now looking at reimbursement mechanism just to ensure that the benefit of whatever they intended has been given. So it means post GST also, through a fiscal route, the reimbursement route, they continue to provide whatever concessions a particular state government has been giving. For example, a new company is setting up, they give an SGST reimbursement for some particular years. So all these are not given as per the exemption route, but rather they're given by way of a policy through a reimbursement route. It is continued to be entertained. So which means that maybe still inequity in terms of taxation, but that is the respective state government's call. So to put it, we have a GST Council, And this GST council is a mix of the central and state government. Central government has 2/3 the overall constitution out of the 100%. Central government has the overall, any decision has to be passed, 75% has to be there. Special resolution 75%, but central government has 66.67%, and the state governments all put together has to work together to pass it. So which means 100% is not required. But as on date, whatever judgments have been, decisions have been taken is through the 100% concession process, except for 1 or 2 decisions related to levy of GST at higher rate, 28% on lottery, which was objected to by Kerala. So otherwise, largely it has been on consensus model. They have built it. Fine. Now, constitutional framework. GST is a very small law since we have about 175 sections. In IGST law is there. So we have CGST Act and the IGST Act. IGST Act is completely under the control of the central government. CGST Act is, of course, central government, and we have respective state GST law, which is also implemented upon. So Tamil Nadu, we have a TNGST Act, and respective states have their GST Act also. Largely 99.99% of the sections are unanimous between the CGST Act and respective state GST Acts, except for few transitional provisions. Otherwise, everything is largely the same. So this is the overall, including Jammu and Kashmir. Jammu and Kashmir adopted it slightly 7 days later after GST came into picture. Right now, the law, most of you are aware that we have to have 4 ingredients to levy the tax. That's a popular judgment in Govind and Gangashan. So there are 4 ingredients to have a tax firm tax levy. One is that the character of the imposition should be known, which is what is the taxable event, which taxable event attracts the law. In GST, the taxable event is the word called supply. So the word supply has been defined in the law also, but it's a very inclusive definition. It is like defining the word called God. So you can say this is God, that is God, but you may not define what is or who is God. So it is included. So there's an inclusive definition for the word called supply. So that is number 1. That's the taxable event. Second, who has to pay this tax? The person on whom this levy is imposed. Who is liable? So there is a person called taxable person. Like income tax law, we have assessee or taxpayer. We have taxable person. The word itself is taxable person, and it has to be very clearly understood that there is no concept of the word direct tax, indirect tax as regards the levy of GST is concerned. It means that nobody can go and say I have not collected the tax from my customer, so I cannot pay. So that is not the word of direct tax and indirect tax is only an economic concept. As regards the law is concerned, they have no relationship per se. So it means the taxable person is defined, and mostly the person who is supplying the product or a service is a taxable person. In few cases, the person who is receiving is also treated as a taxable person. It means you have both supplier in 95% of the cases. In 5% of the cases, recipient being cast the role of a taxable person. So the second. Third, the rate at which tax is being imposed. As of now, the law says you can impose maximum 20% under state law and CGST law. It means overall 40% is what you can levy. So that's been defined. The rate of tax up to 40% in the law has been defined, but it can be amended. The GST Council can say, now it is 40, after 2 years, it could be 80% also. So that is purely the amendment prescribed or suggested by the council, because this is one of the concern of the state governments, because once the law, petrol, diesel comes inside GST, the rate of tax might get regulated upon, which presently state governments carry their own VAT rate in respective states. So you go to Puducherry, Pondicherry, you will find the petrol diesel rate is cheaper by at least 4 to 5 rupees or 6 rupees. It's because the local VAT rate of Pondicherry, they have kept it a lesser rate. So this flexibility of the state governments to either increase the VAT rate or reduce the VAT rate probably may get removed if it comes to GST. So that is where there are some concerns of the state governments, and the central government nowadays levies special cess, on the petrol, which of course those powers may also be, have to be waived off if it has to come into GST. So these are the concerns as regards the rate of tax. The fourth is on the value, on which value you pay the GST. Here the law says you have a supply. On that supply, you have to measure the value, and we have a value separate section is there, and session is also there, which is section 15, which says you have to pay GST on that value. So this is quite which means the law per se is clear on what we have to pay GST on. Now, one interesting point, it uses the word, supply, etc. If this is a charging section. Today, we are just looking at when GST would come. In deeper aspects, we'll discuss in the next session. But then one is we should have the supply, and it says CGST Act, it says GST or SGST, it is intrastate supply. If it is IGST, we're looking at interstate supply. From one state to another state, we supply it. It could be one union territory to another union territory. It could be outside the state, outside the country also. All those will fall under IGST. Then second is it should be goods or services or both. So it means now you can see in the act also there's a word called goods or services. In the constitutional amendment also there's a word called goods or services. There is one definition in the constitution. There is another definition in the law also. But there's no definition for the word supply in the constitution per se. Next, on the value, which is determined as per section 15 of the act, rate is 20%. It should be paid by taxable person. Very simple definition. This is what is section 9. So we have to understand what is a supply, what is intrastate, etc., to interstate, etc. So we'll have to go one by one into each of these points. But before that, just the overall, GST provision per se. So we are looking at, the context is that you already had service tax, VAT in the pre-GST scenario, service tax, VAT, and excise law. And then we are continue to now GST. One of the promising requirement, or one of the, I would say, the statement of objects of GST is to eliminate cascading effects, and of course to ensure continuous chain of tax credit. That means earlier, if I sell from Tamil Nadu to Maharashtra, it was CST, and that CST paid is a cost in the entire process. Nobody can take any tax credit. My buyer cannot take any tax credit because it was going to origin state. Now that GST is being levied, tax credit flows. So there is a continuous chain of tax credit is ensured in GST. That's the underlying promise which continues to be there. However, we have to understand that there is a Supreme Court judgment on this matter of tax credit. Of course, we'll discuss that more in detail later. But in this context, because these are all some of the constitutional issues in the GST is that. So in pre-GST, I would have accumulated some credits. What will happen into the GST? Law has some transitional mechanism. It said you can carry forward those transactions into your GST also, like that they have mentioned. But then, to what extent, whether it is unconditionally given, can government restrict that transition? Those are all matters which are presently under the constitutional challenge. Some cases already been held in favor of the department, saying that it is purely one of the fundamental judgment in the indirect tax law, especially in the context of tax credit, is the TVS Motors in 2019. There are quite a few judgments recently, which has consistently held that any GST input credit given, tax credit given, is only a benefit. We can't equate this to a TDS scenario. TDS is a different provision altogether, where it's basically our tax is being paid. Whereas in GST or indirect tax per se, whatever taxes you pay on the expenditures, on my expenses, all these expenses, law says you can take credit in various scenarios. But all these credits which you can take is governed by the law, the legal provision, and it is only a benefit which has been conferred on the taxpayer. It is purely the legislative prerogative to deny credit to you. You can say that you are not eligible for input tax credit at all. It can be denied. And that powers are vested with the law. In fact, the law can lapse your input tax credit also. So there is a, the Supreme Court consistently has held the view that any tax credit is only a benefit and not an absolute right. Having conferred the right, it becomes a constitutional right. But if it is not conferred, it is only a benefit. That means you cannot go back and tell the government that I please give me tax credit for these expenses also. No, that was not the constitutional framework, the law. So which means we are looking at now there should be a supply. There is a supply should be there. We should supply something. It could be either a good product or a service. The law has defined it. it is intrastate or interstate. That's all. We are just looking at only one section, and this section defines the entire GST provisions per se. So intrastate means we levy one type of tax. Interstate means we levy another type of GST. Both are GST only, but then the levy of GST difference between this. Now, some of the questions which comes up is what is the goods and what is the service. This has also been defined in the law, which is almost similar to what we have in the Sale of Goods Act for the definition of goods. Every kind of movable property is goods. So anything which is movable or capable of being moved is considered as goods, but it excludes money and security, that is shares and listed securities, mutual funds, etc. That is excluded. But then every kind of movable property. So it means if I sell, which leads to one simple question, that at my home I have my old used laptop. I am selling it through some online portal. I am selling it through Quicker or any online portal. Is it a goods? Yes, absolutely it is a goods. But is it a supply or not? It's very important, because just because it is goods, it is not taxable. It has to be supply of goods. So for supply, there's one definition is there. So unless we see the definition of the word supply, the word goods cannot be seen on an isolated basis, but every kind of movable property is goods. Anything other than goods is a service. So that's all they said. The service is anything other than goods. So they have just not made too much complication. Now the question is there anything which can fall in between these two? So it says money and security are excluded in both the segment. That means if I give loan, very simply put it, if I give a loan to somebody else, that loan is only a money. So I'm giving you 1 lakh rupees to my friend. That 1 lakh rupees is only a money. That's all. There is no supply involved in the underlying scenario. But however, having used the money, if somebody uses this money and if I generate interest out of that, now that interest can become a supply because it is an additional consideration. So purely a transaction in money per se cannot be taxed. So that is money. This also includes, for example, I have my customer outstanding, debtors are there. I have to receive money from various people. Now I could not receive money from these people, so I am just writing them off in my accounts, bad debts or whatever. All these are purely a transaction in money. So I don't do, there's no additional consideration flowing here. So it is purely of money. So if it is money, it is not at all covered. Now, one interesting question came up very recently is about Bitcoin. So if somebody deals in Bitcoin, somebody who buys or sells Bitcoin, whether Bitcoin or any other you'll find cryptocurrencies, which is a very popular topic nowadays. So this cryptocurrency, are they considered as money or not? That was the question. Maybe participants may also put it in the chat box if you feel what could be the answer. So the cryptocurrency per se, I give cryptocurrency, let's say I give a Bitcoin, and then for giving a Bitcoin, I receive, probably I had more Bitcoin with me. So I am, instead of giving you in rupee form, I'm giving you a Bitcoin and I'm receiving services or whatever. Now the question is whether the Bitcoin which I'm holding, if Bitcoin is a money or not. So there is a definition for the word money, and money definition says it is legal tender. It has to be a legal tender or any currency as approved by RBI. A Bitcoin for now is not treated as a legal tender or not approved by RBI per se. Of course, it's not illegal also, because the law has nobody said it's illegal. It only says it's not a legal tender for money. That means you cannot officially use it for the exchange of the transactions in terms of RBI bank facilities. So it means RBI has not considered or approved the Bitcoin as a currency per se. So because it is not a currency per se as per RBI, it cannot be treated as a money as per the definition in GST Act. It means if somebody deals in Bitcoin, it can be treated as goods. Though, of course, it means that if I have some Bitcoin, I'm giving it to you, it can be treated as goods. Of course, subject to the underlying point, I'm supplying goods. Supplying means we'll see the definition later, but it is treated as goods only. To put it in a simple term, it can be treated as goods. So what we are looking at is money and security. So if I buy or sell shares, if I buy or sell, mutual fund, debt, bonds, etc. Even fixed deposit, as simple as putting money in FD. So these are all transactions purely in money. So there is no other consideration involved, nothing. So it is excluded from both goods or services. However, if I do other than money, in relation to money, for example, a brokerage firm earning brokerage for facilitating the purchase or sale of shares, that will be treated as a transaction liable for GST. So it will be treated as a service. It says anything in relation to conversion. For example, foreign exchange broker, I give $1 and I receive 75 rupees. It's only a transaction in money. However, for doing this conversion, the brokerage firm charges, let's say, 1% commission. So that 1% commission would be treated as a service. So in relation to money is taxable. Money per se cannot be taxed. So when I say money per se, anything we have to look at purely monetary amounts is involved, that cannot be treated as money. So first thing we are looking at in GST is there has to be either a goods or a service. And what is goods or service? Probably there are sufficient judgments in the old law which becomes relevant to understand whether something is goods or service. Probably just to touch, because excise law also, we had issues about whether something is goods or services. So largely some of the reliance you may have to keep on the old law also as regards. So question is now whether precedents, how far they are relevant. Whether some precedents happened in central excise law or service tax law, whether they are relevant to the extent that they are the words are carry the same meaning. Yes, they are relevant under the existing law also, and probably courts will also rely on already relying on the precedents to conclude certain matters as regards GST law also concerned. So precedents are still relevant. What is movable or immovable is something which we already had a lot of disputes in the old law, both in service tax, VAT, as well as in central excise law. So those meanings will continue to be there in GST per se. So this is the first understanding, that we should have either a good or a service. Now, question that arises is, an employee gets a salary for providing the employment services. Is it a service per se? The answer is yes, it's service per se. There is no, if you see the constitution also, nowhere it says that, employment activities outside the scope. Employment is not a supply, like that is not given, though we'll see later point in time. So it's a very, very vast definition. And what will happen to land? Let's say I have a land and I sell land. What will happen in that case? If there's a sale of land, what will happen? Land is immovable, no doubt. So it cannot be goods. So naturally it will fall under the word called service. Whether we levy GST or not is secondary, but then it will be considered as a service per se. It may be excluded by a separate provision, but service goods definition is very broad to cover anything in between them also. However, there can be certain things which may fall in between that as we keep evolving, we will get to know. So goods, service, there are institutions which we have to be careful. For example, I'll give we look at the example in the context of lift. A lift, is it a goods or a service? If that is probably a question which keeps coming up. So a lift is considered, there are established precedents which also says lift will be treated as a it will not be, it is treated as immovable, it's not movable, to put it other way. So because the entire structure of lift is of course attached to the building, and the building is immovable, and lift also becomes, the concept of lift comes into existence only after it is being attached to the building and it becomes functional. So it means it will be treated as immovable, and hence it is a service. So anything is not goods automatically becomes a service. Now this definition of goods and service is very important, as I told you, to know whether rate of tax, everything would change based on the, for example, I'll tell you, in a restaurant, you go to a restaurant and then you have food there. Of course, everybody knows it's a service, no problem. Now, the same restaurant where you're having the food, you will find they'll have a small bakery setup where they will pack food and give it to you. So whether that is goods or service, I'm not talking about delivery. I'm talking about where, they give you, let's say you are going to A to B. They may also have a counter where they will have the pre-cooked or pre-packed items that may be sold. Same food also, you may be having it there also. So what is goods or service is important. I'll tell you why. Restaurant, it will be treated as service at 5% GST. The same product, pre-packed, cooked, pre-cooked, packed everything together, will be treated as goods, and it will be liable for either 5% or 12%, depending upon whether it is Indian sweets or other sweets. So it means a product and a service rate of tax are different. So it is first step we should understand in the entire league is whether the subject matter are we dealing with, is it a good or is it a service? That is the first subject we have to understand. Having decided whether it is a good or a service, whether it is movable or immovable, basis that we decide. The next thing we come into existence is what is the supply and what is the value, etc. Of course, we'll be discussing more on this in the subsequent sessions. But then the first thing is about the goods or services. Now we said that the levy is on the taxable. One of the condition is levy is on the taxable person. That's one of the basic conditions. And some cases the taxable person is the supplier, and some cases the taxable person is recipient. We call it in our language as reverse charge mechanism. That is largely it is supplier. In few cases it is recipient. In some cases it's neither of them. It is some other person. So we have cases where it is neither the supplier is taxable nor the recipient is taxable, but somebody else somebody is held responsible. Somebody is determined as example. That is where we have section 9(5). What we am talking about is section 9, and 9(5) talks about it. This was popularly come up after so much of litigations, etc. Let's take the example of we all use Uber, Ola, Swiggy, Zomato, Oyo. So many e-commerce operators are there. So let's take the example of a typical Uber or Ola scenario. So who is the service provider there? If you find Ola or Uber, they don't own any infrastructure, in the sense they don't own any vehicle, most likely. It will be the drivers or some vehicle owners are there who own the vehicle, and they empanel themselves as part of Uber or Ola, and in turn they provide the services. So what Uber Ola does is only connecting people. That's it. Connects the consumer and connects the driver. That's it. The owner of the vehicle. These are the two people involved. And what Uber Ola does is just connecting these two. It means they are only an agency. We call in our GST language as intermediary. They are just only intermediary, e-commerce intermediaries. However, what happens is you will find crores of transactions happens through Uber or Ola. Initially, service tax period also, notice was issued on Uber to pay service tax on them. In fact, it will be quite interesting. They didn't have a place of business itself in India to serve the notice. It has to be outside India only. Then they mandated that every e-commerce operator should, appoint some agency or should have a place of business in India. That was in fact a specific provision in GST law also. Now the next question is, okay, assuming they have place of business, so who is supplier of service there? If you look at the underlying service, it is car passenger mobility services or transport service. Now this transport service is being provided by Uber. No, they are not. It is provided by the driver. So only the driver provides services, and who is the recipient of the service is the end consumer. So basically 2 people, and you will find 95% of the drivers are not GST registered because they will be doing turnover less than 20 lakhs or earlier service tax law less than 10 lakhs. So they were not registered under the law. So no GST on them. And recipient also consumers, so you can't demand from them. So government thought they have a huge revenue potential. So they said, in between intermediary, who's the intermediary here? The e-commerce platform is deemed as the supplier of this service. So they have notified now 5 services, which is deemed by the e-commerce, not everybody. The section 9(5) has been provided only to have deemed supplier for certain services, only services. It cannot be for goods. Goods is not covered. Services they have listed. So who are all the categories? One is Uber Ola types, which means transport of passengers by car. Second is you will find Urban Clap, who largely does housekeeping and maintenance. Third is Swiggy Zomato, which is food restaurants. Fourth, you will find Oyo, basically for accommodation. So these people are deemed service providers. Technically speaking, they are only earning commission in this overall process. They are only agents. They are not a service provider per se. However, the law deems them to be a service provider, and they are liable for GST to this extent because of section 9(5). So which means, to put it simply, in many cases supplier, In some cases, recipient, and in few cases which is specifically notified under section 9(5), it is neither of them, but rather the facilitator, e-commerce operator who lies in between. The section 9(5) scope is only limited to services. And in that services also, they have defined, notified what are all the services that can be covered. In fact, the law uses the word category of supplies or category of supply of services. The word uses category of supply of services. So there have been interpretations of the word, what is called category of supply of services. It means you have to notify the service per se, or you have to notify the supplier also. For example, should I say for this service, only intermediary, or if the service done through these people, it is intermediary. So what is called category? There have been a lot of issues going on around it. But then largely we are looking at, first thing, there is to be goods or service. Second, taxable person has been notified, supplier, recipient, or any other person as notified under section 9(5) of the Act. And overall, constitutionally speaking, there is no definition for the word supply. And of course, we are looking at the back-end provisions where it talks about the entertainment tax continues to be levied by local authorities, but not by state governments, which has been quashed recently by Patna High Court also. So it is all to be seen in the context of the present scenario, which is we are looking at 2023 end is this first year for conclusion of assessment in normal scheme of assessment, without invoking extended period. That is the first year. So which means we still have a long way to go as regards even these words are concerned. One last point with that I'll probably conclude this discussion is, the question about personal transactions. So for example, at home, we do a lot of transactions. Now we sell old laptops from our house, whether that is liable for GST. At my home, I may have my old gold chain. I may exchange it with my with the jeweler there. What the jeweler does is taxable. What I am giving it to the jeweler, would that be taxable or not? So these are all questions which we get answered in the subsequent sessions. But however, the another question which comes up is, let's say a charitable trust does these activities. Okay, one first basic limb is personal at our home, what we do. The next limb is a trust whose objective is only to have non-for-profit organization. Whether they do all these activities, whether that will be liable for GST or not, those are all points which comes under the definition of supply and its ingredients of supply. That we will continue in the next session. I think with this I'll conclude my discussions on the basic charging section of 9. Any doubts or discussions? Welcome, sir.
Any questions from the floor? I think Mr. Srinivasan, right time we started the learning program of GST, because as you said, this is going the first year, 2023 is going the first year in which TRSMA is going to be framed. So we are on the right track and right time to learn about the nuances of the GST. And the next program next month will be on scope and classification of supplies. And we expect this to be a physical program. The date and venue will all be announced later on. We hope that more and more chartered accountants and advocates join the program for the next meeting. And I thank one and all for being here. It has been a very long program and eventful day for us, where Mr. Arjun took us through the entire 270A section. And now Mr. T.R. Srinivasan has started with the GST, first topic on GST, and it's been going on very well. We hope to continue this process into the next meeting as well. I thank all the attendees here today for being here with us, and hope to see you all in the next meeting. This will be a physical one. Mr. Sridhar, anything to add?
Yeah, thank you very much, Mr. Srinivasan and Mr. Arjun. Thank you very much. And next meeting will be physical meeting, and Srinivasan will continue his presentation with this second topic. And we are planning for a larger meeting, next meeting, physical meeting. And we are planning to, the notification will come to you shortly. And probably probably the topic under the direct tax will be international taxation. And we will come out with the notification as early as possible. And I hope that there should be more attendees. It's a learning process. Thank you very much.
Thank you, sir.